Good afternoon, everyone. Today we will be discussing about long-term financing with a case study of Facebook's profitability and ability to release cash dividends.
Now let's define what is long-term financing. A long-term finance can be defined as any financial instrument with maturity exceeding 1 year, such as bank loans, bonds, leasing, and other forms of debt finance, and public and private equity instruments. A debt or a bond is a fixed income security that pays periodic interest, but doesn't represent ownership in the company. The firm receives money from the investors in the amount of principal paid at the time for the bond. A maturity refers to the length of time between origination of a financial claim, loan, bond, or other financial instrument, and the final payment date, at which point the remaining principal and interest are due to be paid. And lastly, equity. Equity has no final repayment date of a principal, can be seen as an instrument with non-finite maturity. Equity has two forms, common and preferred. Now let's know what are the sources of long-term financing. Equity capital. This equity loan or capital represents the fund raised by a company using either initial public offering or private investor. Advantages are no repayment obligation, improves creditworthiness. Disadvantage are dilutes ownership, dividends are not tax deductible. Debentures or bonds. A long-term debt instruments issued by companies to raise capital. It is fixed interest payments and repayable after a specific period. Advantages are no dilution of ownership, interest is tax deductible. Disadvantages are mandatory interest payment, increase financial risk. Third, term loans. A loan that offers a fixed repayment period from 3 to 10 years. These are usually used to fund large projects or invest in capital expenditures such as purchasing and renovations. Advantages are flexible repayment schedules and can be secured or unsecured. Disadvantages are requires collateral and fixed interest burden. Fourth, retained earnings. It is also termed as plowback profits. Profits reinvested into the business instead of being distributed as dividends. Advantages are no interest or repayment and strengthens financial stability. Disadvantage are limited availability and may reduce dividends to shareholders. Fifth, lease financing. Instead of buying assets, an agreement where one party, lessor, allows another party, lessee, to use an asset and pays periodic rentals. Advantages are lower initial costs, flexibility, and tax benefits. Disadvantages are higher term costs, lack of ownership, and restrictions on use. Last, public deposits. These are funds that companies raise from general public, employees, and shareholders by accepting them as deposits, offering higher interest rates than banks. The advantages for the company are lower costs and simpler processing compared to other financing options. Advantages for investors are higher returns and short maturity. The disadvantages for a company are short maturity, limited funds, and uncertainty. Disadvantages for investors are no security, no tax exemption, and risk of default. Now, why long-term finance is important? Long-term financing is helpful in multiple forms to run business without a shortage of funding. Also, long-term finance contributes to faster growth, greater welfare, shared prosperity, and enduring stability in two important ways: by reducing rollover risks for borrowers, thereby lengthening the horizon of investments and improving performance, and by increasing the availability of long-term financial instruments, thereby allowing households and firms to address their lifecycle challenges. Number 1. Capital expenditures. Long-term financing is important when investing in capital expenditures such as developing infrastructure, purchasing plant and machinery, and expanding existing facilities. Number 2. Expanding business. By providing the funds required to introduce new products, penetrate new markets, or buy out rival companies, long-term financing makes it easier for firms to grow. Number 3. Liquidity and stability. An organization's stability and liquidity are enhanced by long-term funding. It lessens the need for short-term debts and lowers the chance of experiencing financial difficulties by ensuring a steady and dependable supply of financing over a longer period. Number 4. Manage debt and cost efficiency. Long-term financing enhances the debt management of the business and strengthens its capital structure. Generally, long-term finance offers lower interest rates than short-term ones. Thus, the cost efficiency of the business can be improved along with providing less burden due to the financing over time. Lastly, number 5. Research and development. Long-term financing is beneficial in supporting the research and development centers of the business. For innovation and improvement of business operations, funding in R&D is crucial, and long-term investments enhances this procedure. Businesses can concentrate on innovating new products and services to compete in the market. Now, let me discuss what are the advantages of long-term financing. Number 1 advantage is larger expenses are affordable. Long-term financing helps businesses to afford capital expenditures such as buildings and equipment. They can fulfill the long-term capital goal of business. If more capital expenditure and assets are available, then it can support the growth and expansion of the business. Number 2. Better repayment options. The repayment procedure of long-term financing is flexible. Businesses and financial institutions prefer long-term financing as they get a longer repayment period, and they can gain a stable income flow. Number 3. Credibility increases. Engaging in long-term financing, businesses can grow their credit by ensuring investors that they can repay their loans. This helps enhancing collaborators among investors and corporations. More larger and better opportunities for borrowing build up in the future. And lastly, better repayment options. Long-term financing offers financial flexibility by providing funding that helps in affording different activities, expenses, and projects. Further, by taking loans, borrowers can invest to generate extra income. This will allow a lower monthly repayment condition, and the loan can be repaid within a short period. Now, what are the limitations of long-term financing? First is higher interest rates. Due to its longer repayment period, there is a risk associated with the lenders. Although there is a steady flow of income for an extended period, there is an increased risk for the same long period. Thus, the lenders offer higher interest rates to cover the increased risk. This process also helps lenders protect them from inflation risk, as when they receive their amount back, the value of the amount won't remain the same as it was at the time of lending. Second, risking of losing collateral. While availing the long-term finance, the borrower puts up their asset as collateral. Hence, if the borrower is unable to repay the loan, there is a high chance of losing the collateral. As for the lender, as the amount of the funds is high and the repayment period is long, to combat the risk, collateral is required by the lender. Therefore, being a borrower, they face the risk of losing their collateral until the debt is completely paid off. Third, stricter terms and conditions. Another disadvantage of availing of long-term financing is that it demands too much crucial information about the borrower. Similar to personal loans, business loans offered by financial institutions or corporations look back into the financial history and from profitability to the history of repaying loans. Lenders look for reliable borrowers as long-term financing involves huge sums of money and longer repayment periods. Hence, if any borrower has no credit score, availing of this form of financing would be a bit difficult. Lastly, maintaining longer duration repayment period. The repayment period is so long that this might impact the credit score and make the cash flow negative until a strong debt repayment strategy is built. Long-term loans require monthly repayments for a long duration on a consistent basis, and if one fails to be regular in repaying, then it would impact their credit score. Later on, this would create a hard time in availing another loan in the future. Now let's go to our case study, Meta Platforms Incorporated. Formerly Facebook Incorporated. Meta Platforms Incorporated is a rapidly growing technology company that makes a significant amount of money through platforms like Facebook, Instagram, and WhatsApp. Meta has the financial means to distribute dividends, but instead of doing so, it would rather reinvest its earnings in AI, expanding the metaverse, new product development, and strategic acquisitions. The company's reputation and regulations have been at risk due to a number of issues, such as data privacy scandals, disinformation campaigns, and antitrust investigations. The business's robust cash flow and profits despite these issues demonstrate that its dividend policy is a strategic decision rather than a constraint. By leveraging retained earnings for innovation and competitive advantage, Meta underscores how a growth-focused company can sustain profitability, enhance technological leadership, and maximize long-term shareholder value while navigating public scrutiny and regulatory pressures. Let's discuss the income statement of Meta. Here, the net income of Meta is divided by their total revenue. So, 62,360,000 divided by 164,501,000 is equals to 0.379 or 37.9%. This means the company's net profit margin is approximately 37.9%, indicating a very strong ability to convert revenue into profit. This suggests efficient cost management, strong pricing power, or a high-margin business model, allowing the company to retain nearly 38 cents of every dollar earned. Such a margin is well above average for many industries, signaling robust profitability. It also indicates the company's capacity to generate substantial earnings, supporting reinvestment in innovation, strategic acquisitions, and long-term growth initiatives. Next, the cost of revenue is divided by the total revenue. Therefore, 30,161,000 divided by 164,501,000 is equal to 0.183 or 18.3%. Which means the company spends about 18.3% of its revenue on delivering services, indicating a highly efficient cost structure. This low ratio complements the strong net profit margin of 37.9%, suggesting that the company maintains significant profitability by controlling service costs. Such efficiency often reflects operational excellence or a high-value service, positioning the company well above typical industry cost structures. In growth and earnings per share, the company experienced a significant EPS decline in 2022, dropping from 13.77 in 2021 to 8.59, likely reflecting a challenging year or extraordinary costs. However, it rebounded sharply in subsequent years, with EPS soaring 73% in 2023 and 60% in 2024, and continued growth of 15.5% in the TTM period, demonstrating strong recovery, resilient profitability, and effective operational execution. This pattern highlights the company's ability to overcome setbacks and sustain long-term earnings growth, reinforcing confidence in its capacity to generate increasing shareholder value. The income tax expense divided by the net income. So, 8,303,000 divided by 62,360,000 equals to 0.133 or 13.3%. Therefore, Facebook's income tax expense accounts for about 13.3% of its net income, which is relatively low compared to standard corporate tax levels. This suggests efficient tax planning or the use of tax incentives, allowing the firm to retain a larger share of its earnings. A lower tax burden directly supports the company's strong net profit margin, enhancing overall profitability and providing additional resources for reinvestment or growth. Here's our references. Thank you for your attention, and I'll leave you this quote from my favorite book by James Clear. Living below your current means increases your future means. The money you save this month increases your purchasing power next month.